Keeping the same Medicare card does not mean you are keeping the same cost, the same doctors, the same drug coverage, or the same protection. That belief is costing retirees money right now. Medicare has confirmed the 2026 numbers, and the standard Part B premium is now $202.90 a month. The Part B deductible is $283. The Part A hospital deductible is $1,736 for a benefit period. A Medicare drug plan may charge a deductible as high as $615. Those numbers matter, but they are not the most dangerous part. The most dangerous part is that one ordinary financial decision you made in 2024 may already be changing what is taken from your Social Security check in 2026. A retirement account withdrawal, a Roth conversion, a capital gain, extra interest from a certificate of deposit, or income you no longer receive can move you into a higher Medicare premium bracket. You may not see the connection until the deduction appears. By then, most people assume nothing can be done. Pay close attention to this. Medicare does not always price your coverage according to the life you are living now. For 2026, Social Security generally looks at modified adjusted gross income from your 2024 federal tax return to decide whether you owe an income-related surcharge on Part B and Part D. That means a person who stopped working, sold a business, lost a spouse, or retired with a much smaller income can still be charged as though the old income is continuing. The government sees a number on a return. It does not automatically see the story behind that number. This is not automatic. If your income fell because of a qualifying life-changing event, nobody is going to tell you about this at the moment you need it most. You have to claim it. And before this is over, I will show you why a difference of only $1 can create a Medicare cost of more than $2,000 for a married couple in a single year. Most people believe Medicare is one bill. It is not. It is a chain of separate charges that can arrive through different doors. Part B may be deducted from Social Security. A Medicare Advantage plan may advertise a $0 premium while you still pay the Part B premium. A Part D plan may charge its own premium, and Social Security may deduct an additional Part D income surcharge separately. A doctor may accept Medicare, but a facility, laboratory, anesthesiologist, or medical equipment supplier may create a different cost. A medication may remain covered, but move to another tier. A pharmacy may remain open, but lose preferred status. A hospital may remain in your county, but leave your plan's network. The card in your wallet looks the same while the machinery behind it changes. This is why the official confirmation matters. In 2026, the standard Part B premium rose from $185 to $202.90, an increase of $17.90 a month. The Social Security cost of living adjustment for 2026 is 2.8%. Imagine a retiree receiving a gross Social Security benefit of $2,000 a month. A 2.8% increase is about $56. Before that person pays one higher grocery bill, one higher homeowner's insurance bill, or one higher electric bill, the Part B increase can take $17.90 of that gain. The retiree sees a larger gross benefit and assumes the entire increase improved the household budget. It did not. The net amount is what buys food and pays utilities. The system communicates gross numbers in one notice and deductions in another. The retiree lives on what remains. There are protections in the law for some beneficiaries when a Part B increase would otherwise erase a Social Security increase, but those protections do not eliminate the need to examine the notice. They do not protect everyone in every situation. People who pay an income-related surcharge, people who are new to Part B, people who are billed directly, and people whose circumstances differ from the usual Social Security deduction process may see different results. The safe habit is not to assume. The safe habit is to compare the gross Social Security amount, the Part B deduction, any Part D deduction, any income-related adjustment, and the plan premium as separate lines. I have spent decades studying how these systems connect, and the first lesson is always the same. The enemy is not one clerk, one bank employee, one insurance agent, or one government office. The enemy is the invisible mechanism created when many separate rules interact. The IRS collects tax information. Social Security uses certain IRS information to determine Medicare income surcharges. Medicare sets national rules and cost-sharing amounts. Private insurers administer Medicare Advantage and Part D plans under federal contracts. Banks and brokerage firms issue information returns. Retirement custodians report distributions. Credit card companies price debt according to risk and credit history. The Federal Reserve influences the interest rate environment, which changes what banks pay on deposits and what lenders charge on debt. Each institution sees one piece. You feel the combined result in one monthly budget. Watch how this works. A retired couple has $110,000 in a traditional IRA, $40,000 in a savings account, 2 Social Security checks, and a small pension. Their bank offers a higher certificate of deposit rate because market interest rates are elevated. That extra interest is welcome, but it appears on a Form 1099 INT and becomes part of adjusted gross income. Their brokerage account distributes dividends reported on Form 1099 DIV. A mutual fund sells holdings and passes through a capital gain distribution, even though the couple did not personally place a sell order. Their IRA custodian reports a withdrawal on Form 1099-R. On the tax return, those separate items become a single income picture. Social Security does not ask whether the extra interest was used for a new roof or whether the IRA withdrawal paid a hospital bill. It sees modified adjusted gross income. For Medicare income-related premium purposes, the number is generally adjusted gross income from the tax return plus tax-exempt interest. That last part surprises many careful investors. Municipal bond interest may be exempt from federal income tax, but it can still be added back when Medicare determines the income-related monthly adjustment amount. A retiree can hear the words tax-free and reasonably believe the income is invisible to Medicare. It is not invisible. This changes everything because a financial product can be tax-efficient for one purpose and still increase a Medicare premium for another purpose. The system is built around forms and data matching. A bank does not decide your Medicare premium. A credit bureau does not decide your Medicare premium. A cash transfer from checking to savings is not automatically taxable income. A deposit from the sale of your own property is not automatically income in the amount deposited. But records matter. Financial institutions generally report cash transactions over $10,000 on a currency transaction report, including multiple cash transactions that aggregate above that amount in one business day when the rules apply. That report does not mean you did anything wrong, and it does not by itself raise Medicare premiums. It shows something more important. Financial systems are designed to recognize patterns, identify transactions, and create records. Trying to break a legitimate cash transaction into smaller pieces to avoid reporting can create a much worse problem. Normal, documented activity is safer than behavior that looks designed to hide. Credit works the same way in a different system. Most credit scores range from 300 to 850. A retiree with a strong score may qualify for better loan terms, while a retiree with high card balances and missed payments may pay far more for the same amount of borrowed money. Credit scores do not set Medicare premiums, but debt decisions can indirectly create Medicare consequences. A person may take $45,000 from a traditional IRA to eliminate credit cards charging 22 or 24%. Paying off expensive debt may be sensible, but the withdrawal can create federal and state income tax, make more Social Security benefits taxable, and increase Medicare premiums 2 years later. One decision can solve one problem and quietly create 3 others. This is why retirement planning cannot be separated into isolated boxes. A 401k withdrawal is not only a retirement decision, it may be a tax decision and a Medicare decision. A Roth IRA conversion is not only an investment decision. The converted amount is generally taxable income in the year of conversion and can affect future Medicare premiums. An inheritance is not automatically a federal estate tax problem for an ordinary family, especially when the federal basic estate tax exclusion for 2026 is $15 million. But an inherited traditional retirement account can still create taxable distributions for the beneficiary under the rules that apply to that account. A home sale may create a large bank deposit, but the Medicare effect depends on the taxable gain that reaches the return, not the size of the deposit alone. Here's what almost nobody understands. The amount of money moving and the amount of income counted are not always the same number. The first major revelation is that the Medicare surcharge is based on a tax year that can be 2 years behind your present life. The official name is the Income-Related Monthly Adjustment Amount, usually called IRMA. For 2026, an individual with 2024 modified adjusted gross income of $109,000 or less generally pays the standard Part B premium of $202.90. A married couple filing jointly with $218,000 or less generally pays the standard amount for each enrolled spouse. Above those levels, Part B rises in steps. The first higher level is $284.10 per person per month. The next is $405.80, then $527.50, then $649.20. At the top level shown for 2026, the Part B premium is $689.90 per person per month. Part D can add a separate income-related amount from $14.50 to $91 a month on top of the plan's own premium. Those are not marginal tax brackets. A tax bracket normally applies a higher rate only to the next layer of taxable income. IRMA is different. It works more like a set of stairs. Cross the line and you step onto a higher monthly premium level. That is why careful people are sometimes shocked. They did not become wealthy. They sold stock to help a child. They converted an IRA while the market was down. They took a required distribution. They received a final year of salary and a severance payment. They collected a large amount of bank interest after moving cash into safer deposits. Then, 2 years later, a letter arrives from Social Security. Consider Robert and Elaine. Robert retired in March of 2025. Elaine had already retired. Their household income in 2026 is about $86,000 from Social Security, a pension, and modest withdrawals. But their 2024 joint tax return showed $246,000 because Robert was still working, received a bonus, and sold company stock. Social Security can use that 2024 return for their 2026 RMA determination. The couple opens the notice and believes the higher premium is permanent. It may not be. Work stoppage and work reduction are qualifying life-changing events for an RMA reduction request. Social Security uses Form SSA 44 for this process. The form can allow a person to report a more recent, actual, or estimated modified adjusted gross income and provide evidence of the qualifying event. This is not automatic. Social Security does not always know, at the moment it calculates the surcharge, that Robert stopped working. The IRS data shows the old year. The retirement date may exist in payroll records, but the premium system does not automatically rebuild the household story from every available document. Robert and Elaine have to read the notice, understand why the surcharge was imposed, determine whether the income reduction came from a qualifying event, complete the request, and provide support. Nobody's going to tell you about this in the supermarket, at the bank counter, or when the retirement party ends. You have to claim it. Form SSA 44 recognizes specific life-changing events, including marriage, divorce or annulment, death of a spouse, work stoppage, work reduction, loss of income, producing property in certain circumstances, loss of pension income, and certain employer settlement payments connected to bankruptcy or reorganization. A simple decline in an investment account is not automatically the same as a qualifying event. A voluntary decision to realize fewer capital gains is not necessarily a qualifying event. The facts matter. The evidence matters. A pay stub, employer statement, death certificate, divorce decree, pension letter, or other documentation may be required depending on the event. The emotional damage often begins before the financial damage. A retiree opens a government envelope and sees a premium hundreds of dollars higher than expected. The first feeling is not calculation. It is fear. The person thinks, I worked for 40 years, paid Medicare taxes, saved what I could, and now the system is taking more because I had one good year. A widow sees her filing status change from married filing jointly to single and realizes the income thresholds are lower for one person. A veteran who never missed a bill receives a denial notice for a medical service and feels as if a machine has judged the entire life behind the claim. A couple starts avoiding the doctor because they do not understand which costs are covered. I want to slow down here because these are not abstract numbers. A $200 monthly surprise is $2,400 a year. That can be a property tax installment, several months of groceries, a car repair, or the amount a family had planned to set aside for grandchildren. A $400 monthly surprise is $4,800 a year. That can erase the income from a small pension. When people say their money is evaporating, this is often what they mean. Not one dramatic theft. A premium here, a copay there, a drug moved to another tier, a deductible reset in January, an interest charge on a credit card, and a tax bill caused by the withdrawal used to pay the last bill. There is a more intelligent way to act. It begins with refusing to treat every notice as background noise. Medicare letters, Social Security premium notices, the annual notice of change from a private plan, bank tax forms, brokerage statements, and retirement distribution forms are pieces of one picture. The person who connects them early has choices. The person who waits until a deadline passes may have fewer choices. Fear is not the goal. Awareness is the goal. You do not need to become an accountant. You need to know which numbers can change your next decision. The next rule is the one that quietly reduces the value of the Social Security cost of living adjustment. The 2026 COLA is 2.8%, but the standard Part B premium increased by about 9.7% from the 2025 amount. Those percentages measure different things, so they should not be compared as though they were the same program. But your checking account does not care which agency calculated which percentage. It only sees money coming in and money going out. If your gross benefit rises by $56 and Medicare takes another $17.90, your net increase before other deductions is $38.10. If a drug premium rises by $8 and a supplemental policy rises by $20, the apparent raise can nearly disappear. Many retirees make the same mistake in January. They compare the new Social Security deposit with December and assume any difference is only the COLA. But January can include a new Part B amount, a new Part D premium, a new Medicare Advantage premium, a new IRMAA level, or a change in tax withholding. The correct comparison is not one deposit against another. The correct comparison is the gross benefit notice against every deduction listed. Think of a paycheck stub. The top line is not spendable income. The bottom line is. If this information is useful to you so far, leave a like. It helps more retirees find explanations that can protect money they spent a lifetime building. Now look at the Part A hospital deductible. In 2026, it is $1,936, and it is tied to a benefit period, not simply one deductible for the entire calendar year. A benefit period begins when you are admitted as an inpatient to a hospital or skilled nursing facility and ends after you have not received inpatient hospital or skilled nursing care for 60 days in a row. A person can face more than one Part A deductible in a year if separate benefit periods occur. That surprises people who hear the word annual used around other insurance deductibles and assume all Medicare deductibles reset only once each January. For hospital days 61 through 90 in a benefit period, the 2026 Part A coinsurance is $434 per day. Lifetime reserve days are $868 per day. Skilled nursing facility coinsurance for days 21 through 100 is $217 per day when Medicare coverage requirements are met. These figures are not predictions or worst-case inventions. They are the official 2026 cost-sharing amounts. A supplement, retiree plan, Medicaid, or Medicare Advantage plan may change what an individual actually pays, but the person must know which coverage is responsible. The word Medicare on a card does not answer that question by itself. Original Medicare also usually leaves the beneficiary responsible for 20% of the Medicare-approved amount for many Part B services after the deductible. And Original Medicare by itself does not have a yearly out-of-pocket maximum. That does not mean every retiree should choose Medicare Advantage. It means every retiree should understand the risk being accepted. Medigap can cover certain gaps, but premiums vary. Enrollment timing matters, and outside protected enrollment rights, an insurer may be allowed to use medical underwriting in many states. Medicare Advantage plans have annual out-of-pocket limits for covered Part A and Part B services, but they also use plan networks, cost-sharing schedules, and utilization rules that can change. A $0 Medicare Advantage premium is not $0 health care. You still pay the Part B premium unless another program pays it for you. You may pay co-payments for specialists, imaging, outpatient surgery, inpatient stays, rehabilitation, and durable medical equipment. You may pay more out-of-network or have no non-emergency coverage outside the network, depending on the plan type. The extra dental, vision, hearing, transportation, food, or fitness benefits can be valuable, but an extra benefit should not distract you from the hospital copay, maximum out-of-pocket limit, drug formulary, and provider network. Here's a realistic example. Linda chooses a plan with no additional monthly premium because her dentist participates and the plan offers a hearing benefit. In September, the plan sends an annual notice of change. She places it under a catalog and never reads it. The next year, her preferred hospital is no longer in network. Her specialist copay rises from $35 to $50, and one medication moves to a higher tier. The plan did not hide the changes in the legal sense. It mailed the notice. But the information arrived in a thick envelope written in language most people do not enjoy reading. The system assumes notice was given. Linda experiences the change only when the appointment is scheduled and the pharmacy price appears. Medicare plans send the annual notice of change in the fall, generally by the end of September. It explains changes that take effect in January. Medicare open enrollment runs from October 15 through December 7. This is not automatic. Automatic renewal can keep you enrolled, but it does not guarantee that your doctors, drugs, pharmacies, copays, benefits, or costs remain the same. The quiet danger is believing that doing nothing preserves the old plan. Doing nothing usually accepts the new terms of the renewed plan. The safest way to review a plan is not to ask whether the premium is low. Ask whether every important medication is on the formulary, what tier it is on, whether prior authorization or step therapy applies, which pharmacies are preferred, whether your physicians and hospitals are in network for the coming year, what inpatient and outpatient costs apply, and what the annual maximum out-of-pocket limit is for covered medical services. A plan can be excellent for your neighbor and expensive for you because your doctors and prescriptions are different. This brings us to retirement account withdrawals. Required minimum distributions generally begin at age 73 under current federal rules for traditional IRAs and many retirement plans, although workplace plan details can differ. A required distribution adds taxable income. A large traditional IRA can therefore create larger distributions over time, and those distributions can increase the income used for IRMA. The government is not imposing IRMA because the money came from an IRA. It is imposing IRMA because the taxable distribution increased modified adjusted gross income above a threshold. Imagine a 73-year-old veteran named Michael. He has a pension, Social Security, and a traditional IRA worth $780,000. He also has $18,000 on a credit card after replacing a roof. He decides to withdraw $45,000 from the IRA, enough to satisfy his required distribution and eliminate the card. The decision may be reasonable. The card interest stops, but the full picture includes income tax, possible taxation of more Social Security benefits, and a future Medicare premium effect. A better decision might still be to withdraw the money, but it should be made after estimating all three consequences, rather than looking only at the credit card statement. The same is true for a Roth conversion. A conversion can reduce future traditional IRA balances and future required distributions. It can provide tax-free qualified Roth withdrawals later. It can be valuable for heirs, but the converted amount generally enters taxable income in the conversion year. A $70,000 conversion may fit inside a tax bracket and still cross an IRMA line. This does not make Roth conversions bad. It means the amount and timing should be coordinated with Medicare thresholds, expected capital gains, charitable giving, pension income, and required distributions. People often ask whether a deduction will solve the problem. Here is the distinction. Taxable income and adjusted gross income are not the same number. The standard deduction, itemized deductions, and certain additional deductions can reduce taxable income without reducing the adjusted gross income used in the Medicare calculation. The additional federal deduction available to eligible people age 65 and older for tax years 2025 through 2028 can reduce federal taxable income subject to its rules and phase-outs, but that does not automatically mean it reduces IRMA. Medicare begins with adjusted gross income and adds tax-exempt interest. A deduction that occurs after adjusted gross income may lower income tax without lowering the Medicare number. Most people never realize this because tax software shows a smaller taxable income figure and a smaller federal tax bill. The retiree reasonably thinks income has been reduced for every purpose. It has not. Different programs use different definitions. The IRS can use taxable income for one calculation, adjusted gross income for another, modified adjusted gross income for another, and provisional income for the taxation of Social Security benefits. Medicare uses its own modified adjusted gross income definition for IRMA. One household can have several official income numbers in the same year. This is where professional coordination becomes valuable. A financial advisor may recommend a conversion. A tax professional may calculate the federal tax. An insurance agent may discuss plan premiums. An estate attorney may discuss beneficiaries and trusts. Each professional can be competent and still focus mainly on one area. The retiree has to ask the connecting question. What will this transaction do to my Medicare Part B and Part D premiums 2 years from now? This content is educational and does not replace personalized financial, legal, tax, accounting, or insurance advice. The purpose is to help you ask the right questions before the transaction becomes irreversible. The next quiet trap is Part D. Medicare confirmed that the out-of-pocket cap for covered Part D drugs is $2,100 in 2026. That is meaningful protection. It can save people with very high covered drug costs thousands of dollars compared with the old structure. But the phrase out-of-pocket cap can create false confidence if you do not hear the words covered Part D drugs. A drug not covered by the plan's formulary does not automatically count the way a covered drug does. Premiums do not count toward the cap. Drugs obtained outside the plan's rules may not count. The formulary, pharmacy network, utilization requirements, and exception process still matter. A Part D plan may also have a deductible as high as $615 in 2026, although some plans have lower deductibles or no deductible. The deductible may apply differently to different drug tiers depending on the plan. After the deductible, you may pay co-payments or coinsurance. A 25% coinsurance charge on an expensive medication feels very different from a fixed $10 copay. Two plans with similar premiums can produce dramatically different annual costs for the same person. Medicare also offers the Medicare Prescription Payment Plan, which allows a participant to spread covered out-of-pocket drug costs into monthly bills from the plan instead of paying the pharmacy all at once. This can help cash flow, especially when drug costs are high early in the year. But watch the wording. It does not save money. It does not lower the drug price. It changes the timing of payment. The monthly amount can change as new prescriptions are filled because the remaining balance is divided over the months left in the year. Suppose Carol fills an expensive prescription in February and would otherwise owe $200 at the pharmacy under her plan's cost-sharing rules. Spreading that amount can protect her checking account from one sudden hit. But if she joins late in the year, there are fewer months over which to spread future costs. If she misses plan bills, collection rules and participation consequences can follow. The payment plan is a budgeting tool, not a discount program. Nobody's going to tell you about this distinction in a 30-second advertisement. You have to understand what the program does and what it does not do. The stronger protection may be extra help or a Medicare savings program for someone who qualifies. Most people think they don't qualify. They remember an old income limit, assume their home counts as a disqualifying resource, or believe a small savings account makes them ineligible. The federal limits rise over time, state rules can be more generous, and states may disregard certain income or resources. Medicare itself tells people to apply even if they do not think they qualify. For 2026, the Federal Qualified Medicare Beneficiary Program lists a monthly income limit of $1,350 for an individual and $1,124 for a married couple, with resource limits of $9,950 and $14,910. QMB can help pay Part A premiums when applicable, Part B premiums and Medicare deductibles, coinsurance, and copayments for covered services. Providers are not allowed to bill a QMB beneficiary for Medicare-covered deductibles, coinsurance, and copayments, although a small Medicaid copayment may apply in some situations. A person who qualifies also receives extra help with prescription costs. The Specified Low-Income Medicare Beneficiary Program lists 2026 monthly income limits of $1,616 for an individual and $2,184 for a married couple, with the same federal resource limits shown for that program. It helps pay the Part B premium. The qualifying individual program lists monthly income limits of $1,116 for an individual and $2,155 for a married couple, also with those resource limits. QI helps pay the Part B premium, but it requires a new application each year, and states approve applications on a first-come, first-served basis, with priority for people who received the benefit in the prior year. Those are federal baseline figures. Alaska and Hawaii have somewhat higher income limits, and some states allow people to qualify with income or resources above the federal figures because states count certain items differently. The home you live in, one vehicle, household items, burial funds within rules, and other assets may receive different treatment depending on the program. Do not disqualify yourself by memory. This is not automatic. You have to apply through the state. Most people think they don't qualify, and many never complete the application that would have answered the question. Think about the impact of this. The 2026 standard Part B premium is $290 a month. If a program pays that amount for an eligible person, The value is $2,134.80 over 12 months. For a married couple with both spouses enrolled and eligible, the combined value can approach $4,169.60 before considering deductibles, coinsurance, co-payments, or drug assistance. This helps lower-income retirees directly, and the broader planning process helps comfortable middle-class retirees avoid surcharges and plan mistakes. This helps both lower-income retirees and comfortable middle-class retirees, but the form of protection is different. Now tell me in the comments, did you already know that Medicare savings programs can have different state rules, or is this the first time you are hearing it explained this way? The next revelation concerns prior authorization. Many retirees hear that Medicare covers a service and assume the plan must pay as soon as a doctor orders it. Coverage, medical necessity, documentation, network rules, and prior authorization can stand between the order and the payment. In Medicare Advantage, a plan may require approval before certain services. Beginning in 2026, affected payers are required under federal rules to provide a specific reason when a prior authorization request for a medical item or service is denied. The requirement does not apply to drug prior authorization under that particular rule. For affected payers, expedited decisions generally must be sent within 72 hours and standard decisions within 7 calendar days. That confirmation matters because a vague denial can paralyze a patient. A specific reason gives the doctor and patient something to address. Missing records can be supplied, a coding problem can be corrected, a coverage criterion can be discussed, an appeal can focus on the actual dispute, but the existence of a rule does not guarantee that the patient will understand the notice, preserve the deadline, or ask the doctor to act. This is not automatic. A denial reason is useful only when someone reads it and responds. Picture a 68-year-old retired school employee named Denise. Her orthopedic surgeon recommends a procedure after months of pain. The plan denies the initial authorization because a required therapy record is not included. Denise hears the word denied and assumes Medicare has decided the procedure will never be covered. She cancels the follow-up appointment. In reality, the denial may identify missing documentation that the physician can submit. The difference between a final loss and a corrected request can be one phone call, one fax, one portal upload, or one appeal filed within the required period. Automated systems and artificial intelligence are increasingly used to organize records, detect unusual patterns, estimate costs, and support claims review. CMS itself is testing enhanced technology, including artificial intelligence and machine learning combined with clinician review, for selected services in parts of Original Medicare. Private plans and health systems also use automated tools in different ways. Technology can make decisions faster, but speed is not the same as accuracy in an individual case. A model sees codes, dates, diagnosis fields, treatment history, and documentation. It does not sit at the kitchen table with the patient who cannot climb the stairs. This is where the sensation of being financially observed becomes real without becoming a conspiracy. Medicare claims systems analyze billing. Banks analyze transactions for fraud and regulatory compliance. Credit bureaus compile payment history. Card issuers monitor spending patterns for possible fraud. The IRS receives information returns. Social Security receives tax data for IRMAA determinations. These systems exist for legitimate reasons, including payment accuracy, identity protection, program integrity, and law enforcement. The risk for an ordinary person is not that every system is secretly targeting retirees. The risk is that an error, missing document, unusual transaction, or misunderstood notice can move through an automated process faster than the person knows how to correct it. Keep a simple paper trail. Save the Medicare summary notice if you have Original Medicare. Save explanation of benefits documents from a Medicare Advantage or Part D plan. Record the date of a call, the number called, the name or identification of the representative when available, and any reference number. Keep copies of authorization requests, denial notices, appeal submissions, tax returns, SSA letters, and proof of life-changing events. A well-organized folder is not dramatic, but it can be worth thousands of dollars when a bill or premium is challenged months later. Do not send your Medicare number, Social Security number, bank password, or full tax return to someone who contacts you unexpectedly. Scammers imitate government agencies, insurers, pharmacies, and financial institutions. They create urgency and ask for information that a legitimate caller should not demand in that way. Use the telephone number printed on your official card or notice, or find the official number independently. Never rely only on caller identification. A protected retirement plan can be damaged more quickly by identity theft than by an investment decline. The same discipline applies to the annual notice of change. Read it beside last year's evidence of coverage. Mark changes in premium, deductible, hospital copays, specialist copays, maximum out-of-pocket amount, drug tiers, pharmacies, and network language. Then confirm important doctors directly with both the plan and the provider's office. A directory can be outdated. A receptionist can be mistaken. The safest confirmation is documented and repeated close to the new plan year. People often focus on the monthly premium because it is easy to compare, but a low premium can hide high use-based costs. Suppose Plan A costs $40 more each month or $480 a year, but your medication is on a preferred tier and your hospital copay is lower. Plan B has no additional premium but charges $90 more each month for the medication and $350 more for a hospital admission. The $0 premium can become the expensive choice. The correct comparison is expected total annual cost under realistic medical use, not the price printed in the largest type. There is another hidden issue for people who travel or spend part of the year in another state. Original Medicare is generally accepted by any provider nationwide who participates in Medicare, while Medicare Advantage network access depends on the plan. Emergency and urgent care have protections, but routine care outside the service area may be limited depending on the plan type. A retiree who spends winter in Arizona and summer in Minnesota may need a different network strategy from a retiree who never leaves one county. A plan that is perfect at home can be restrictive 6 months later. Medicare coverage outside the United States is limited. Some Medigap plans provide a foreign travel emergency benefit under their rules, and some Medicare Advantage plans offer worldwide emergency or urgent coverage, but this is not the same as full routine international medical insurance. A cruise, extended visit with family, or retirement abroad requires separate attention. The cost of one overseas hospitalization can overwhelm years of premium savings. The timing of Medigap deserves respect. The federal Medigap open enrollment period generally lasts 6 months and begins when a person is both 65 or older and enrolled in Part B. During that period, a person has important federal protections when buying a policy. Afterward, unless a guaranteed issue right or a state protection applies, an insurer may ask health questions or charge differently, and an application can be denied in many situations. Retirees sometimes leave Medigap for Medicare Advantage because of a low premium and assume they can return to the same Medigap protection whenever they choose. That is not always true. None of this means one path is always superior. Original Medicare with Medigap and Part D can offer broad provider access and predictable cost sharing, but premiums may be higher and separate policies must be managed. Medicare Advantage can combine medical and drug coverage, include an annual medical out-of-pocket limit, and offer extra benefits, but networks, co-pays, and prior authorization may matter more. The intelligent choice depends on health, doctors, medications, travel, cash flow, state protections, and tolerance for changing plan rules. The next financial trap begins with the sentence retirees hear constantly: take money from the account with the lowest return. That may be too simple. A bank account withdrawal generally does not create taxable income merely because cash leaves the account. Selling an investment can create capital gain. Taking from a traditional IRA can create ordinary taxable income. Taking a qualified Roth IRA distribution may not increase federal taxable income. Borrowing can avoid immediate income but create interest and credit risk. The same $30,000 of spending can produce 4 very different tax and Medicare results depending on where it comes from. Consider a couple that needs $30,000 for a roof. They have $80,000 in bank savings, $400,000 in a traditional IRA, and $90,000 in a taxable brokerage account containing appreciated stock. Using bank savings may reduce liquidity, but not create taxable income. Selling stock may create a taxable capital gain equal to the sale proceeds minus tax basis, not the entire amount sold. An IRA withdrawal may place most or all of the taxable distribution into adjusted gross income. A home equity loan may preserve assets but add interest and a monthly payment. There is no universal answer, but there is a universal question. What does each option do to taxes, Medicare premiums, investment risk, and emergency reserves? Tax withholding creates another surprise. A retiree can request withholding from an IRA distribution. and still have the full taxable distribution included in income. If $20,000 comes out of an IRA and $4,000 is sent to the IRS, the retiree may receive only $16,000 in the bank, but the taxable distribution can still be $20,000. People sometimes plan IRMA around the net check instead of the gross distribution reported on Form 1099-R. The tax withheld pays a liability. It does not erase the income. Qualified charitable distributions can be useful for eligible IRA owners because, when the rules are met, money transferred directly from the IRA to an eligible charity can satisfy part or all of a required minimum distribution without being included in adjusted gross income. But the transfer must follow the rules. Writing a personal check after receiving an IRA distribution is not the same transaction. A donor-advised fund generally is not an eligible recipient for a qualified charitable distribution. This strategy requires coordination and documentation, but it shows why the path of the money matters as much as the purpose. Capital gains create a similar misunderstanding. A retiree may sell $100,000 of stock, but have only $25,000 of taxable gain because the cost basis is $75,000. Another retiree may sell the same $100,000 with a basis of $20,000 and create an $80,000 gain. The bank sees a deposit of $100,000 in both cases. The tax return tells two very different stories. Medicare responds to the income on the return, not the size of the brokerage transfer into checking. Inherited assets can be even more confusing. The federal estate tax applies only to estates above a very large threshold, and the 2026 basic exclusion is $15 million. That means most families will not owe federal estate tax. But that does not mean every inherited asset is tax-free forever. The tax treatment of an inherited house, taxable account, annuity, traditional IRA, Roth IRA, savings bond, or business interest can differ. An inherited traditional IRA distribution can increase a Medicare beneficiary's income. An inherited taxable investment may receive a new tax basis under applicable rules. State inheritance or estate taxes may apply even when federal estate tax does not. A widow can be hit by several changes at once. The household loses one Social Security benefit, often the smaller of the two. The tax filing status may eventually change from married filing jointly to single. The Medicare IRMA threshold for a single filer is half the joint threshold at the first level in 2026, $109,000 instead of $218,000. Housing costs may remain almost unchanged. Property tax, insurance, repairs, utilities, and association fees do not fall by half because one spouse died. This is sometimes called the widow's penalty, but the phrase understates the emotional and administrative burden. Suppose a couple had $180,000 of modified adjusted gross income and paid the standard Medicare premium because the joint threshold was $218,000. After one spouse dies, the survivor has $115,000 of income from pension, Social Security, investment income, and required distributions. The survivor has less household income than before, but can cross the single IRMA threshold of $109,000. The system does not consider that the mortgage, taxes, and maintenance barely changed. It applies filing status and income thresholds. Death of a spouse is one of the life-changing events recognized on Form SSA 44 when it reduces income, so an IRMA determination based on an earlier joint return may be reviewable. But future tax years can still present planning challenges because the survivor's filing status and income structure have changed. Beneficiary designations, account ownership, pension elections, Social Security survivor rules, and withdrawal strategy should be reviewed before a crisis when possible. If you want to continue receiving information like this, consider subscribing to the channel and turning on notifications so you do not miss the next videos. Now, we arrive at the part most people overlook until the money is already gone. Medicare premiums are not based on how wealthy you feel. They are based on defined income thresholds, and those thresholds create cliffs. A household can spend years being careful, then cross a line because of one transaction in December. A mutual fund distributes a capital gain. A certificate of deposit matures and pays interest. A retiree takes extra money from an IRA for a family emergency. A financial advisor completes a Roth conversion. A business makes a final payment. The transaction may be legitimate, necessary, and even wise. But if nobody calculates the Medicare effect, the cost appears 2 years later. Remember the married couple threshold for 2026. Modified adjusted gross income of $218,000 or less on the 2024 joint return generally keeps each enrolled spouse at the standard Part B premium of $202.90 with no Part D IRMA. At $218,001, the couple enters the first higher IRMA level. Each spouse's Part B premium becomes $284.10, an increase of $81.20 a month per person. Each spouse with Part D also owes an additional $14.50 a month on top of the plan premium. That is $95.70 more per person each month. For two spouses, the combined increase is $191.40 a month. Over 12 months, that is $2,296.80. $1 of modified adjusted gross income above the threshold can therefore be associated with more than $2,000 of additional Medicare premiums for a married couple in that year. The extra dollar is not taxed at a $2,000 rate. It triggers a higher premium tier. That is the difference between a tax bracket and an IRMA A cliff. This is the strongest revelation because it shows the system as a silent gear. The IRS return closes. Information moves through government data systems. Social Security applies the income table. Medicare premiums are assigned. The Part B amount comes out of the Social Security check. The Part D adjustment may also be deducted or billed. The retiree notices a smaller deposit long after the financial transaction that caused it. The bank transaction and the Medicare deduction are separated by time, agency, and paperwork, so the connection is easy to miss. At higher levels, the effect is larger. A single person whose 2024 modified adjusted gross income moves above $137,000 enters the level where the 2026 Part B premium is $405.80 and the Part D surcharge is $37.50. Above $171,000, Part B is $527.50 and Part D IRMA is $60.40. Above $205,000 and below $500,000, Part B is $649.20 and Part D IRMA is $83.30. At $500,000 or more, Part B is $689.90 and Part D IRMA A is $91. The exact thresholds and amounts can change each year, which is why planning with an old chart can be expensive. Married people who file separately and lived with a spouse during the tax year face especially harsh IRMA brackets. For 2026, modified adjusted gross income above $109,000 and below $391,000 can produce a Part B premium of $649.20 and a Part D surcharge of $83.30. Filing separately may be necessary or beneficial for legal, debt, student loan, or tax reasons. But Medicare should be included in the calculation. A tax return that saves one spouse money in one area can increase premiums in another. The solution is not to become afraid of earning interest, selling an investment, taking a required distribution, helping family, or converting an IRA. The solution is to calculate before acting when you have a choice. Estimate adjusted gross income. Add tax-exempt interest. Include expected wages, pensions, taxable Social Security, IRA distributions, capital gains, dividends, business income, rental income, and other relevant items. Compare the estimate with the Medicare thresholds for the year that will use that return. Leave room for mutual fund distributions and unexpected income. Then decide whether the transaction should occur all at once, be divided across tax years, be funded from another account, or proceed despite the surcharge because the larger financial benefit justifies it. Sometimes paying IRMA is the correct decision. A Roth conversion may create a temporary surcharge but reduce lifetime tax and future required distributions. Selling a concentrated stock position may reduce catastrophic investment risk. Paying off high-interest debt may improve cash flow and protect a home. Receiving a business payment may not be optional. Good planning does not treat every surcharge as failure. It measures the surcharge as part of the total cost and makes the decision with open eyes. Sometimes the charge can be reduced after the fact. If Social Security used income from 2 years earlier and a qualifying life-changing event caused current income to fall, Form SSA 44 may allow a request for a new determination. The person may use actual or estimated income for a more recent year under the form's instructions and provide evidence. Social Security can later verify the estimate with IRS information and make corrections, refunds, or retroactive assessments when necessary. Estimates should be reasonable and updated if they change. Do not assume an accountant automatically filed an IRMA A appeal. It is a Social Security process, not part of the ordinary federal income tax return. Do not assume a financial advisor sees the premium notice. Do not assume an insurance agent knows the household's full tax picture. Do not assume Social Security will call to offer a reduction. This is not automatic. Nobody's going to tell you about this at exactly the right time. You have to claim it. The practical protection is a yearly retirement money review with 4 time periods. Look backward at the tax return that Medicare is using. Look at the current year's expected income. Look forward 2 years to the possible Medicare effect. Then look at the next enrollment period for plan changes. This is not a formal government method. It is a simple way to stop time delays from hiding consequences. Start with the Social Security notice. Verify the gross benefit, Part B deduction, Part D adjustment, tax withholding, and net deposit. Then compare the IRMA determination with the correct tax return. Check filing status, adjusted gross income, and tax-exempt interest. If the data is wrong, gather the return or amended return. If income fell because of a recognized life-changing event, review Form SSA 44 and the evidence requirements. If the surcharge is correct, plan for it rather than allowing the smaller deposit to destabilize the household budget. Next, review the Medicare plan. Confirm doctors, hospitals, medications, preferred pharmacies, prior authorization, copays, deductibles, and maximum out-of-pocket exposure. Do not compare only premiums. Read the annual notice of change when it arrives in September. Use the October 15th through December 7th open enrollment period when a change is appropriate. If you are in Medicare Advantage, remember that there is also a Medicare Advantage open enrollment period from January 1st through March 31 for certain changes, but the available options and rules are not identical to the fall period. Then review the tax year before December ends. Required distributions, Roth conversions, capital gains, charitable gifts, business income, and interest can sometimes be managed before the calendar closes. After midnight on December 31st, many opportunities disappear. A trade may settle in another year. A distribution may be irreversible. A charitable check may not qualify as a direct IRA transfer. The difference between planning in November and reacting in February can be thousands of dollars. Finally, review assistance programs without embarrassment. Medicare savings programs, extra help, state health insurance assistance programs, Medicaid offices, and plan appeals exist because the rules are complicated. Free, unbiased counseling through a state health insurance assistance program can help a beneficiary compare options and understand notices. Applying for help is not taking something from another retiree. It is using a program funded and created for people who meet the rules. The system favors people who understand the timing, the definitions, and the forms. That does not mean the rules are fair in every personal situation. It means knowledge creates options. A retiree who knows that tax-exempt interest counts for IRMAA can estimate before buying a large municipal bond position. A widow who knows that death of a spouse can be a life-changing event can ask for review. A person who knows the Part D payment plan only spreads costs can search for true assistance instead of mistaking financing for savings. A patient who receives a prior authorization denial can demand the specific reason and work with the physician on the next step. You worked too long to let avoidable confusion drain what you built. The goal is not to distrust every bank, insurer, doctor, or government employee. The goal is to stop giving blind trust to automatic systems. Automation is efficient, but it does not know your intentions. A tax form does not know that the IRA withdrawal repaired a leaking roof. A claims code does not know how pain affects your sleep. A credit score does not know that you missed a payment while caring for a spouse. A premium table does not know that your income disappeared after retirement. The human story enters only when a person documents it and uses the correct process. There is still time to act more intelligently. Open the notices. Keep the tax return. Ask which year Social Security used. Estimate income before a large withdrawal. Verify whether a life-changing event applies. Compare total plan costs, not advertising. Apply for assistance even when you are uncertain. Preserve denial letters and deadlines. These are ordinary actions, but ordinary actions are how families protect extraordinary amounts of lifetime effort. Share this video with a spouse, a parent, a veteran, a coworker approaching retirement, or a friend who believes Medicare renews without meaningful changes. Sharing accurate information can protect someone before the next premium notice, drug refill, hospital bill, or tax decision arrives. And if you think this is already important, watch the next video appearing on the screen now. In it, I explain another rule that can directly affect the money of millions of retirees, and that almost nobody is watching until the deduction has already begun.